Welcome back to Take Charge. I'm Tim Stanovic in New York. Well, Fed Chair Jerome Powell will testify before the Senate Banking Committee today. He's likely to face questions over the inflationary risk posed by the proposed stimulus plan. It's something that the White House's chief economic advisor, Brian Deese, spoke with Bloomberg TV about in an exclusive interview on Monday. Take a look.
It's a risk that we're keeping our eye on, and certainly it's something to consider. But if we look at the recent history over the last couple of decades, we've seen that the economy has the capability of running at stronger paces. And we think that the tools exist to manage those risks as we go forward. We can debate different ways of measuring the output gap, measuring the risks associated with this particular crisis. But if you sum it all together, we are at a very precarious and unique moment of economic crisis. And that's why we feel pretty confident that we will be better off if we take these actions definitively, we put ourselves on a trajectory to growth, and then we work with the tools we have to manage any challenges that we face going forward.
Bloomberg Markets reporter Katie Greifeld joins me now with more. Hey, Katie, thanks so much for being here. Look, we're seeing quite a sell-off today in tech stocks right now. The NASDAQ down 2.5% coming after yesterday's slide of just about the same. How is this sell-off that we're seeing connected to concerns about inflation?
So because bond yields have been so low for the past year, but really the better part of a decade, you've seen growth companies such as Tesla, such as the FANG names that are also getting slammed, they've really benefited from this environment. You know, they're thought of as duration heavy assets, which sounds pretty scary, but it just means that, you know, growth companies tend to borrow a lot to fuel that growth. So now with inflationary concerns, bond yields perhaps moving higher, that has really taken a bite out of those companies. You know, it was the tech companies that had let us out of the really pandemic crash a month or a year ago now. But now you've seen them really sort of straggle since September. And instead, you're seeing kind of the beaten down companies such as energy shares and financials. They have really been leading the market over the past month. And that's because those are the type of sectors that would benefit if we truly are in an inflationary environment and people are going out into the economy and spending their money more.
So if borrowing costs go up, if the cost of your inputs go up, if you're a company and you're buying these products, that affects earnings, it affects the bottom line, and investors react like they're reacting right now.
Exactly. So, I mean, inflation isn't black and white, and whether it's good or bad really depends on your point of view. But generally, good inflation would be wages paid to workers going higher in a sustained, steady fashion. That can be bad news for companies if your input costs are also rising, if you're paying more to acquire materials to make your products. But if you're a company and inflation means that you're getting paid more for your products, kind of offsetting those input costs, that's probably good for your bottom line.
So all of this now comes to Jerome Powell later today. What do we expect to hear from Fed Chair Powell when it comes to inflation, and what types of questions do you think he'll be asked?
So it's a funny position that we're in because Wall Street and economists have been saying there's inflation coming, you know, prepare. But Powell has really taken a different tone. He's said in the past multiple times that even if we do get a pickup in price pressures and inflation's coming out of the pandemic, it probably won't be the sort of sustained increase that would cause the Federal Reserve to act. So you'll probably hear him make that case again today. And you'll probably also hear him say that Congress really needs to get moving on this fiscal aid bill, this $1.9 trillion package that the Biden administration has proposed.
I mean, it's like a broken record with Powell, right? Anytime he speaks, he says, okay, we've done as much as we can. It's basically now time for policymakers to act.
Exactly. I mean, he's really done a good job at sticking to his message. And that message is, like you're saying, that the Fed has done so much. They put so much monetary stimulus into the system, kept it easy for companies to borrow, but only Congress has the power to directly distribute checks to Americans, to put money in your pocket. The Fed simply can't do that.
I wonder if we're going to start to hear a different tone from Fed Chair Powell and from the Federal Reserve as a whole, given that we are getting improved economic data, and investors are also signaling with bond yields going up that they are more confident about where we are in the recovery. And maybe they're pricing in the aid package actually being passed at this point. But will that change the way that Powell messages around when he wants to raise interest rates?
That's the big question. You have seen some analysts from Wall Street banks say that the market is basically going to force the Fed to hike rates before they want to. the Fed policymakers have not been as concerned. You've heard multiple policymakers come out in recent weeks and say, we're not too fussed about the rise in bond yields. And if you look at historical graphs, it kind of makes sense. So we're talking about the 10-year Treasury yield. It's at about 1.3, 1.4%, which historically speaking is still very low.
Yeah, but relative to where we were over the summer, that is a huge increase.
It is a huge increase, but over the past decade, the average yield on the 10-year Treasury is higher than 2%. So we still have a long way to go probably before we're even at historical norms.
All right, well, there you have it. Bloomberg's Katie Greifeld. Hey, Katie, thanks so much for your time. We appreciate it.